Hello and welcome to the World Built Environment Forum webinar series. My name is Simon Rubinson and today we're discussing the results of the Q1 RICS Global Commercial Property Monitor. To help me make sense of the results and to understand some of the themes and the issues that are dominating the debate in the real estate sector, I have an excellent panel with me today, and I'm just going to introduce them quickly. First of all, we have Kate Agnew. She's Head of Real Estate Valuation and Natixis. Her past professional roles have included leadership at two of the big four accounting firms. She's also been involved with various banks and in private practice. Good morning to you, Kate, I believe, isn't it?
Yes, it is still morning here. Thank you, Simon.
Welcome. The second panelist is Jos Brushfield. Jos has over 20 years experience in both direct and indirect real estate investment and financing in the UK, Europe and Japan, and that includes active asset management and development of distressed UK assets. Good afternoon, Jos.
Hi there, Simon.
Hello. And Suzanne Eichelmann-Rieper, I think many of you may be familiar with her. She is chair of the RICS German board, and she's a former PwC partner. Good afternoon, Suzanne.
Hi, Simon.
Nice to have you here. And the fourth panelist is Adam McLennan. He's managing director and head of UK and Ireland PKF Hotel Experts, and I think, Peter, you've got over 20 years experience in the sector, and you've had a lot of consulting experience and managed assignments in Europe, Africa and the Middle East. Good afternoon, Adam.
Thank you, Simon. Good afternoon.
It's good to have the four of you here because I think some of the issues we're going to be discussing today will really touch on some of your areas of expertise. So I look forward to hearing your thoughts on what's happening in the market and what is likely to happen. But as ever, we really do want to hear and get questions from those of you listening into this webinar. So please do use the question box, submit your questions, and I'm sure we will get round to them. And we really want it to be a multi-level conversation rather than just a dialogue between me and the panelists. So do please take advantage of the opportunity. Now, let me just highlight the results of the Q1 monitor. Just to remind you, of course, this is a sentiment survey. It doesn't pretend to be anything other than a sentiment survey, but it is quite a survey that has a good record as a lead indicator of key trends. And as a high frequency survey, it also is able to draw on quite a significant cohort of respondents, typically around 3,000 each quarter. So it's not an insignificant sample around which to base the insights that we're gathering through this survey. So what are the key conclusions of the Q1 monitor? Well, perhaps in alignment with what we're hearing about the upgrades of global growth, particularly in the US, and also the divergence between what's happening in some advanced economies and perhaps some of those less advanced economies, that the overall trend in terms of news flow is improving. Sentiment, as measured by the Global Property Sentiment Index, climbed at a headline level to -27 in the quarter. Now that is a significant improvement in the trend. It's a continuation of the trend, but it's critically indicating that the direction of travel is towards a more positive outlook for the sector. Now, this is a headline index, I should stress, and as such, it captures a range of the underlying components. And I have to acknowledge that within that, there's some pretty stark trends around sector Not surprisingly, that continues to be really very relevant. And that affects, not just retail, but also the offices, and clearly what's going on in logistics and hotels also comes out very clearly in the feedback that we received. But in terms of that headline Global Property Sentiment Index, when we break it down by region, it's rather strangely almost uniform. So within that region, within the regional breakdown, there's a lot of dispersion amongst countries. But if you look at this first chart as such on your screen, you can see that certainly in the run-up to the pandemic, there was quite a bit of divergence between the broad regions, and the Middle East and Africa was really a bit of a laggard over this period. I think we've discussed some of the reasons for that on previous webinars, and you can see Europe, the red line there, was performing relatively well. You've got that sharp dip down and the subsequent bounce, and it is interesting just how uniform the feedback that we're getting at a regional level is. If one were to look at it by broad group, be it occupier and investor, there's a little bit more variation. And perhaps not entirely surprisingly, investors are looking through some of the ongoing macro challenges. Now, I mentioned in my opening slide and didn't dwell on it, the upgrading to global growth. And there certainly is a head of steam around this. And the IMF, in its April forecasts, revised up pretty much the numbers for everywhere, both for this year and next year. The US was the strongest at 1.3 up. That's on top of where they were for this year, and 1% up for next year. But there was a broad trend moving up between 0.2 and 0.5% on the numbers. But I think for many occupiers, that is the future. And certainly, notwithstanding the stark, as I used the term before, sector divergences, the overall picture for a lot of occupiers remains challenging as we move through this period where restrictions in some economies gradually begin to get lifted. Clearly, in some parts of the world, that isn't going to be the case, and the issues around COVID remain pretty intense. But perhaps that explains why investors with that forward-looking view are beginning to already respond a little bit more aggressively in terms of their feeling about the outlook for the market. Now, that divergence does happen periodically, and you can see after the global financial crisis 2000, 2008, 9, you saw a broadly similar trend, but I think it's even more marked at the present time. Moving on to looking at the country level data just briefly, I mentioned that there was quite a lot of variation on sentiment, that aggregate headline number, when you looked at it by country, even if the regional numbers that we're getting all seem to coalesce around a similar sort of area. So this is the same, this is a representation of that headline sentiment index by country. The blue diamonds or the turquoise diamonds are the previous reading. I've put some bars in red just because I suppose we're going to have more of a focus today on Europe and the Americas, so I just identified some of the main markets that might fit into that category, but you can see the broad range. Remember, this is feedback from the respondents that we're getting. It is not my view, it is simply a coalition, a pulling together of all that insight that we get from the respondents to the survey. And you can see towards the right-hand side, a range of countries, quite a range of countries, but China and the UK and Australia towards that right-hand side. So I suppose towards the slightly more positive side, if you're looking at some of the larger markets, or the more interesting markets for some people. And if you look at the other end of the scale, you can see UAE still sort of languishing, and then some of those European markets also, as well as Singapore. So Spain, France and Italy, we're still getting quite mixed feedback. And Germany is just a little bit higher up there, as you can see, somewhere between the UK and the rest of Europe, and the US also similarly in the middle area. But what is noticeable is that in pretty much every case, there's an improvement compared with Q4, which is not surprising. Now, I talked about the sector divergence, and I think that's going to be inevitably a big theme for our conversation today. And I wanted to just present the 12-month rent expectations figures. Again, it's simply a pulling together of the feedback that we received. This is a point estimate, so it's slightly different. It is presented slightly differently. What you can see here for the Americas as a group and Europe, this is weighted. So in the Americas, the US will have obviously a very large weighting. So it's capturing a lot of the US story here as much as anything else. And in Europe, obviously, the UK will have quite a large weight. But you can see here the broad directions of travel and in a way the consistency. There are some divergences. Prime offices, the Americas number looks to be softer in terms of the outlook than Europe somewhat, and perhaps secondary industrial stroke logistics, the Americas a bit stronger. But overall, what is clear is that the broad pattern is fairly similar, with retail numbers or expectations about retail still pretty downbeat, logistics seen as an ongoing winner, hotels still being still a bit cautious looking at this, data centers strong, aged care and health generally on the positive side, and also multifamily. And if we were to look at the capital values and the numbers that we get for 12 months, the picture wouldn't be dissimilar, and certainly the broad trends would be very similar. There were two additional questions that we asked in the latest survey, and I just want to finish off with those before opening up for debate. The first of these was around the time that it would take for revenues to return to pre-COVID levels by asset. And we had a request to include this by a key stakeholder, and we broke down the categories according to their level of interest. So it was, a response to a particular request, but I hope it gives you an idea of what the expectations are around the recovery of revenues. This is not, giving us a significantly different feel to perhaps what we saw with the 12-month expectations chart that I presented previously. Industrial stroke logistics clearly still seen as being the asset class with the quickest turnaround in terms of revenues. You might express surprise actually that in some places it's the assumption is that it may take longer than a year or so for those assets to actually drive revenues back to where they were pre-COVID levels. But the overall trend, I think, is not surprising and consistent with the 12-month expectations figures that we got. And then the final slide I just want to highlight was a question that we asked in the middle of last year, but we've just asked again this time round, and that's about the office sector. Obviously, a lot of discussion about hybrid working, who's going to go back in the office. I don't know if anyone on the panel is working in an office today. At RICS, I haven't gone back to the office as yet, I think there is obviously related to that discussions about the office footprint being scaled back. What you can see here is that the broad trend again between Americas and Europe is not that dissimilar. The most ticked box in terms of the Americas is that the footprint would be scaled back between 5 and 10%. You can see as far as Europe is concerned, there are a slightly higher share of respondents who are taking the view that perhaps it won't be scaled back at all, or if it is scaled back, it will only be up to 5%, something like 40% of total tick those two boxes. So perhaps in Europe, in aggregate, there's an expectation that the scaling back will be slightly more modest than in the Americas stroke US, but I don't think it's sort of dramatic. And I think on the other hand, the other way of looking at this is it's certainly not suggesting that this is the end of the office. It's certainly it's sort of, to my mind, consistent with the view that the vast majority of people will be going back at least part of the time, if not most of the time, back into the office environment. But again, we will come back to discuss that in due course. Now, I'm going to sort of finish at that point. I think that's hopefully giving you a bit of bit of background on the survey and the sort of the headline results that we received for it this time round. And what I want to do now is start by just getting some initial feedback to what I've said, and also just some thoughts as to what individuals might be seeing in their own market. And I'm going to start with Suzanne here, just to sort of open the discussion.
Thank you, Simon. So I can say from your perspective, I can agree to all those figures from the sentiment. But in the EU, you should know, in some EU countries, lockdowns are currently being ended and corona measures are relaxed. But in some countries, however, the number of infections is throwing a spanner in the works. And when you look at Europe, we have some borders, and due to the COVID-19 pandemic, travel restriction exists for entry from many countries. And when entering from risk areas, there's an obligation for digital entry registration, an obligation to test for the coronavirus, and depending on the regulation on the federal state, an obligation to quarantine. A lot of administrative burden to do business. Yeah, so this is hindering the EU a lot to make business as usual. But my hope is that summertime and the vaccine will help to relax. When we look on the financing, we see money flooding policy. It helps companies in some sectors to forget about the pandemic, and the ECB, and I think also the Fed, are understating the corona pain. Last week, both indicated that they would inject more money if necessary. So on the one hand, this is good news. But back to real estate, and you already said it, the winners and losers, or let me say the resilient ones. Yeah, logistic definitely boost at the moment. Did you know that parcel service providers will need to expand their storage capacity in Europe by up to around 9 million square meters of additional space by 2025 to meet the rising e-commerce demand? This will push logistics and living. That's the same what you said. It's a kind of a new hype, but is it really? No. We all know the importance of the residential market has increased sharply, and maybe we come back in the discussion. Also hotels, I think we have a deeper dive, and also on retail. Just let me highlight the office question for Europe. So from my point of view, hybrid is definitely the way forward, but need that more space. I would like to rise the two game changers, what I see. So working from home, you said it, will stay. That's what some big countries already announced. And if it is 10 or 20%, we will see in the future. But we have to have in mind to reach the CO2 targets, which now upcoming, yeah, the same companies already realize that more office space means more CO2 emissions. And if you look to the sustainability reports, most of them say we use resources responsibly, and this means also be responsible for the office space, and this will maybe come into the mind of a lot of people. So I will follow the market and look what will happen on the new concept. So that's from a European perspective.
Okay, thank you, Suzanne. We'll come back to a lot of those issues, I'm sure, over the course of the next sort of 40 minutes. Joss, how are you seeing things?
Well, I think it's fair to say that over the last 15 months, life has been very bizarre. I don't know about everybody else, but I'm certainly sat in my home office, and I do think that offices will come back quite strongly. I think there is an innate need for it sounds rather pompous, but humans to meet and discuss and debate and be creative. So I think that there's a pretty good future for offices. I think taking a more macro look, we live in a very bizarre world where what is known colloquially as crinkly tin sheds are worth more than shiny office buildings. And that is the world we live in now, where low yields, expectation of rental increases on low cost to build properties can make them worth more than air-conditioned, raised floors, suspended ceilings office buildings. I think that also reflects possibly that there's a bit of a mispricing of office buildings. I think that there is a lot of money moving into the UK at the moment. I think there's a bit of a relief rally due to our good fortune on our vaccine rollout, whether you regard it as good fortune or whether you regard it as good management. It's resulting in a bit of a rally more quickly than other places. I think that there's also a relief rally to a certain extent due to the impact of Brexit being a lot less than everybody thought it would be, and that now, whilst there are impacts, they're being realised to be less impactful than feared. That is allowing money back into the market. So I'm seeing money coming from the Middle East, I'm seeing it coming from Asia, I'm seeing it coming from the States. If anything, the UK domestic investment scene is rather more confused as they unwrap their retail problems and have to deal with them. So I think I'm pretty positive all in all. I think there are some real opportunities, and I think it's also quite worth standing back a little and comparing real estate as an investment class to other sectors, whether it be shares or whether it be bonds or whether it be alternatives, hedge funds, private equity, whatever it might be. Actually, the returns that we have coming from real estate likely in the next few years are extremely attractive in a wider investment context, and therefore I think we will pull in a lot of capital. I think what is also interesting is that there appears to be a massive hole in the middle of the risk-reward curve where people are not investing, and that's in the sort of core plus space. So you're seeing people investing in core, you're seeing people invest in value add and opportunistic, and there's this bit there which is mispriced and which has a bit of an opportunity. So I expect to see a lot of movement, a lot more stock later in the year, and actually quite a big bounce.
Okay, thank you for that, Joss. And again, we'll come back to discuss some of those issues in due course. And Kate, what are your thoughts from the US?
I think in the US, we've got a lot of different vectors that are coming together, and then in some cases coming together and bouncing off and going into other directions. The number one issue right now is vaccinations and how that's going to eventually flow out to the effect on real estate. As of this morning, the CDC is reporting that at least one dose is in the arms of about 150 million US residents with fully vaccinated and 100 million. That's just under 45% for one vaccination. The question there is how much further the vaccination is going to penetrate. The folks that have stepped up for their vaccinations are fairly well satisfied, if you will. They've moved into the second and moved on from there. Getting the next round of people in is going to be difficult, and getting people that simply won't do it will be impossible. So with all that in mind, are the trends that have come forth in real estate because of the pandemic going to remain the same? If the level of vaccination in the United States that caused the real estate conditions continue to be uneven at best. One of the issues we're running into in office is both positive and negative. I feel positively about office overall. I read a Moody's report not long ago that said the average length left on office leases for Class A space is just over 8 years. So that's quite a bit longer than any of us thought. So you have in Class A offices, organizations that are well financed and would be unlikely to necessarily default on their leases. Instead, what they'll want to do is stay and make things work as they are. And as we move in and out of vaccination phases and seeing how hybrid works for individual companies, I think right now companies are making the decision about how far they want to open up, how much space they're truly going to need going forward. With all the seesawing that there has been of how we want to address COVID and sanitary measures in our offices, we've come full circle from we're never going back to the office to some organizations saying we are all going to be back in the office, and then everything in between. Going forward, because the United States is disparate in its approach to this, there will be no ability, even if you wanted to mandate that people be vaccinated to be working again. That's going to be presenting challenges to occupiers of office as well as to owners of office. In an organization that a friend of mine works for, they've been pushing for people to come back to the office. Yesterday, one of the people who was pushing, or actually the day before, was walking around and saying hello to everyone. And a day later, she, who was highly vaccinated, had been exposed to someone with COVID. So a seesaw there, and it was an interesting set of circumstances. How it's also going to affect long-term for things like retail and industrial and hospitality. We've got two outstanding hospitality experts here, but will people continue to enjoy getting things delivered at home? I know I will. So that will keep that segment of the industrial market going. I think Amazon owes much of their first quarter profit to me. True story. But I also wonder about the segments as they're coming back, how long their boom or their bust are going to be. I would never write off New York on any segment, and even now we're seeing residents who left come back. Coastal cities on Los Angeles and San Francisco are looking for their equilibrium now. So I think for the rest of this quarter, at least in the US, it's going to be a tale of vaccinations and finding your equilibrium.
Okay, thanks, Kate. And I'm rather glad my daughters are back at university, because as you talk about Amazon and logistics and the doorbell ringing, at least we're not going to have that problem, hopefully, for the duration of this webinar, but otherwise it may have been a very different story. I now want to sort of turn to sort of the whole issue of hospitality and specifically hotels. And Adam, with your expertise, I'm just really interested to hear what you're seeing in the sector and whether you sense that the sector's, you know, as it begins to open up, whether it's in the position to really gain momentum and get back to where it was quite quickly, or is this going to be drawn out? And also that sort of tension between what's going on in the business world and in the leisure sector.
Sure, thanks again. I'm sitting at home in my home office, having just before the webinar received our last delivery for the day. So pleased to be joining you here. Our firm is a global firm. We've got offices in 14 different countries, and this is a very unusual situation, obviously, as we all know, because pretty much every country has been impacted, and all of the things we've talked about have really hit the hospitality industry, and particularly the hotel industry, very, very hard. Not being able to travel, the people staying at home, hotels being closed all over the world. We went from a period in 2019 of extended growth, where I think UNWTO, UN World Tourism Organization, had estimated about 1.5 billion international arrivals into around the world. That dropped by 74% globally in 2020. So clearly, the hotel industry has been struggling. The vaccine is the key, I think, and most experts and most people are saying that, and Kate, said it for the US as well. And it's really is the key for the hospitality industry's recovery from a demand perspective. Certainly, we're about to see, I think, in mid-May in the UK, hotels allowed to open really for the first time, except for the ones that were perhaps serving airports where people were quarantining or specific, purposes. So if you can't open your hotel, you can't make any money, and I think that's been the struggle for the industry for the past 15 months is that really there's been no money in the industry. Unlike the 8 years for an office lease, the average sort of stay in a hotel is 2 nights, maybe, more or less, depending on where you are. Leisure hotels are longer, and business hotels generally quite short stays. What we're seeing around the world is a fair amount of optimism on a recovery. We do roundtables all over the globe, and I've been attending them in the US and virtually at the moment, normally in person. And the sentiment that we've seen is that people are generally thinking 3 years. I think that your sentiment survey seemed about right. 2 to 3 years, probably from 2023, that we maybe get a recovery to where we were in 2019. And obviously that will depend. I think you had a slide earlier where you looked at the difference in GDP growth or GDP impact of the COVID-19 pandemic. And places where that hasn't been extreme will probably recover more quickly on the business side. I think there's a pent-up demand for leisure, and we're expecting leisure demand to come back more quickly. But with new travel regulations, and again, the vaccine is the key. People may need vaccine visas or passports to be allowed to travel internationally, maybe even to attend some hospitality events. I think we have a Euro football tournament this summer. Will people going to attend a football match, if they're allowed to come in, will they need to have been vaccinated, and how many people will be allowed to come in? And those all generate demand for hotels. Some of the things that we're expecting for 2021, there will be some new travel regulations. The countries that do well will be the ones that have done better in vaccinating their populations and keeping the virus at bay. Easy to reach destinations, so close to the major outbound source markets will benefit. We saw that last summer where a lot of German tourists stayed at home, where they would normally travel in droves, and French tourists as well, and British tourists as well, stayed at home where they would normally travel to sunny climes, perhaps in the Mediterranean. They made the decision to drive to a local resort, local destinations, and so the industry participants, the hotels, the resorts that cater to that will do better, and we'll see a bump, and actually maybe better than they did pre-COVID in some instances. The countries, again, with better vaccination rates will benefit. It'll be a difficult year for the meetings industry. I don't know if you probably go to MIPIM, some of you, on a regular basis, and other big events. Those have all been pushed back, or minimized. And certainly, I think a lot of companies will be reducing their attendance when they are allowed to happen, and they may take a little bit longer to get back to their full flow that we saw, pre-COVID, for a variety of reasons. One, financial, but also safety reasons and sustainability reasons. I think Suzanne touched on sustainability or maybe Simon did as well. That those are things that companies are thinking about. The travel, the carbon footprint of sending people all over the world to events and to meetings, when you can do some of these things online, like we're doing now. And I think some of the companies that were probably in good times were not too worried about their travel budgets have realized that they could actually reduce the impact on their bottom line of COVID, because they haven't actually been sending people around the world, and that will impact the hospitality industry as well. So, sort of long story short, I think the tourism hotels will do better more quickly. I think there's pent up demand. I'm sure you're all looking forward to the days when you can, and our viewers, our listeners are as well, to the day when they can take a holiday and feel safe about it. And as soon as they are allowed and they find a place where they can do that, I think they will. And because of the economic factors, they haven't been prevented. The money in people's pockets has not declined that much in many cases, especially in Europe, where there's been a lot of subsidy, government subsidy that was mentioned before. So people still have money to spend. They haven't been traveling. They haven't been going to the pub in the UK, which obviously drains a lot of people's cash here. So I think that there will be a rebound. There'll be some spikes in demand. I think even in corporate demand, there'll be some business trips that didn't happen that need to happen. There'll be family reunions that didn't happen that need to happen. There'll be memorial services for people who passed and all sorts of things that people will. There will be a spike in demand. And I generally think that we will get back. The hospitality industry was one of the fastest growing businesses prior to COVID, and travel was growing exponentially. And I think we will get back to the levels that we were in, and it will continue to grow.
Adam, can I ask you a question actually? Because someone's just put in a question. So I wanted, and please do send your questions through, but there's the question I've got here, which, how can hospitality adapt in terms of dynamic pricing? That could be by hour or weekday or weekend, based on keeping occupancies high following post-COVID. So do you see there's going to be more, is there going to be more dynamic pricing?
That's one of the things that the hospitality industry's been doing for a long time to try and, so I don't know if there'll be more dynamic pricing. We saw after the global financial crisis, a big, hotels cut rate to increase demand. This is not a financial crisis, so the hoteliers are definitely at least trying to keep the rate high, or at least as high as possible, understanding that the demand should come back, so they don't want to discount too heavily to induce new demand, induce people to travel. I don't think at the moment, if you're not traveling, it's because of safety reasons rather than economic reasons. And so I don't know if there'll be more dynamic pricing in future. I do think that hotels, there will be some opportunities to reduce pricing. And some hotels that perhaps, on the margins will reduce prices because they try and, people will make, some people are out there will make a decision based on price. And that will stimulate some demand, but I don't know about more dynamic pricing.
Okay. Thank you. Joss, can I get your thoughts on the hotel sector? Because I know you have some involvement in that area.
Yes, I actually put a hotel under offer today, so I'm having a good day so far. As Adam says, hoteliers or good hoteliers are very good at dynamic pricing. It's called revenue management in the way that everybody calls different things in different parts of the industry. But revenue management is what delivers profit in hotels rather than just turnover. So it's a very key part, and I've seen huge profits come from proper revenue management, and so dynamic pricing is already well embedded. Looking at what's been going on in the market from people wanting to buy hotels, if you look at what's been going on in the UK market, you've seen Project Horizon, which is a portfolio of Holiday Inn Expresses, has gone under offer to a major US fund for roughly 10 to 15% more than was expected. There's a Hilton in Cardiff that's gone under offer at a similar premium to where the market was expecting it to settle. And there's plenty of interest in the relatively limited number of hotels that are actually on the market at the moment. And so I think that reflects the facts that, as Adam has very eloquently explained, that people are looking over the horizon and seeing that market recovering over the next couple of years. And he's absolutely right that leisure will recover first. Business will take a little bit longer, but will recover, in my view. And actually, I think he's undercooking it in terms of the money in people's pockets. I think it's well known in the UK that the public's got about 100 to 150 billion pounds worth of additional savings in their accounts as a result of not spending during the COVID pandemic, and that is going to result in a big bounce frankly, economically, but also on leisure spend. People have been building up wanting to go away on holiday. They haven't been able to do so, and I think you'll see a lot of travel, leisure travel, recovering quickly, even if business lags a bit further behind. So, in summary, I think we'll see a decent bounce in leisure. I think business will take a bit longer, but owners are looking through all of that and saying, actually, this is a sector I'm quite happy investing in. I'm getting, I'm buying off a 13 multiple for a decent quality hotel in a major city. I can leverage that to 40–50% off a cheap rate, and therefore I can get a cash on cash of 10%, let's say 12%, maybe even, and an IRR in the mid to high teens. And I think that's pretty attractive in the context of the wider market.
Absolutely, yeah. I mean, Kate, from a US and a banking perspective, what are your thoughts?
We still have a lot of concerns about hotels, about the hospitality industry. We see ones that are very well run, that have flexed very quickly, pivoted very quickly. Some of them have taken what looks to be a drastic step to shut down for a while, and that turns out to have been a good long-term play. Within New York City, occupancy in hotels are about 50% right now. You have to be careful about a number like that, though. Is it against hotels that are open, against all hotel rooms, and how much of those are temporary shelter? But still, it's a really positive development. I was surprised at how well the, self-service hotels or limited service hotels were faring in the downturn. In COVID times, they were the ones that remained open and were available to what travelers were going throughout the US and usually driving. No one was going to be flying at that time. And that looks like it's not even a value play anymore, it's a sensible play. From a lending perspective, we're going to want to see lower LTVs. We are going to want to see strong capital plans and a lot more property technology involved in not just revenue management, but similar to what Citizen M had even 4 and 5 years ago, the touchless check-in. That also seems to be outstanding for keeping revenues in line and keeping particularly expenses in line. So it seems to be a win. I'm curious to see what the second half of this year is going to bring in hospitality. And there's the old curse, may you live in interesting times. I am tired of living through historic times.
Yeah, no, absolutely. I mean, we've had another question, which is more about sort of, I suppose, hybrids, but it was sort of suggesting that, and I was going to get to this anyway, but I think it'd be useful touching on it now. Not just the office sector as a hybrid, but I suppose the way that retail is used as being more hybrid. And I think Joss and I were involved in the conversation. I think it was last week, where we were talking in the UK about some retail outlets, business parks, where space is being used for by retailers to support their sort of online offer, as well as perhaps the physical offer as well. And I'm just wondering whether that's something that is going to become increasingly prevalent, not just in the UK, but globally. And I mean, perhaps, Joss, because I think it is a story in the UK. Do you want to start on that?
Yeah, I mean, the UK is fairly advanced in online retail. I mean, in the US, the thing that holds it back is obviously the distance is involved, and therefore the cost of delivery, although it's still, increasing very rapidly. In Europe, you've seen less technology adoption, and therefore it's a little bit behind. But nevertheless, everybody is driving in the same direction, accelerated by 3 to 5 years by the pandemic. I have a significant shareholding in an online retailer, so I've seen the transformation in the last 15 months firsthand, and it's frankly incredible. I think town centres, I think it's easy to get rather depressed about town centres, but they continually reinvent themselves. But if you're in the UK and you drive along the high street, if you look behind the facades of many of these retail units were often residential units 100 years ago, and we're going through the same evolution, the same change as urban centres adapt and repurpose themselves to suit the changes in the economy. So in the medium to long term, I'm positive about town centres. And things like, for example, last mile delivery taking over dark stores and dark kitchens and all that sort of stuff. Is an example of some of those repurposing of urban spaces. But I think in the short term, of course, we're seeing massive seismic shocks. You're seeing, there's a portfolio of loans on the market in the UK at the moment for shopping centres where some of those are under offer at a third of their valuations in 2019. I'm just looking at a shopping centre in the UK where a new buyer has just bought it. Must be the only trade of a shopping centre in the last 12 months, frankly, and they're buying that off £20 a foot. These are shocking numbers and reflect massive change that's happened so very quickly. So we're going through those seismic shocks and aftershocks, but in the medium to long term, I'm positive about the way in which our towns and cities repurpose themselves.
It's interesting that you said earlier, when you look at the pricing of a barn in a field that is now sort of seen as being more valuable than a high-tech office or retail outlet. It's a sign of the times. But
absolutely. And in terms of environment, I think it's quite interesting. So we asset manage an airport, or a couple of airports actually, general aviation airports, and it's interesting to see that occupiers are happy spending almost exactly the same rent on basic space in an open area and green environment as they are spending the same rent on a glossy building in a town centre no more than 3 miles away. So isn't that interesting how people are changing how the space that they occupy, what they want it to look like, what they want the experience to be like?
Yeah, no, absolutely. And can I remind people to take advantage of the questions, the opportunity to ask questions, and just fill in that space with your question, and we'll try and get to it over the next 10 to 15 minutes. Suzanne, in terms of the retail issue, I suppose within Europe, it's I've been Europe ex-UK, I suppose, to be fair, but within Europe ex-UK, there's lots of diverse trends, I suppose, in terms of how retail is playing out. But what are you seeing in Germany at the present time?
Yeah, so first of all, I have to say you are better in vaccination in all countries than Europe is, and most of the shops are closed, only food is open and some other systemic retail. Yeah? So from my point of view, what lies ahead of us is not a pre-crisis normality, but a post-crisis reality. And for some of the discussion, it seems nothing remains as it was. So when you look at the consumer society that is materially well provided, but at the same time well informed, and has shifted its focus on an increasingly non-material satisfaction of needs. Yeah. So if you have lockdowns, if you cannot go for 2 days, if you cannot go to the city because nothing is open, so this has a big impact. So, but against this backdrop, so the retail property stage for feelings and attitudes and lifestyle, it wants to have a future. Yeah, and this future, from my point of view, will be more mixed. There's a lot of discussion to the extensive structural changes which are required for a reuse of, for example, large properties, and a solitary retail reuse in the department stores sense is only rarely successful. So the success of the reuse depends on the mix and of uses, but due to some structural and architectural peculiarities, cost-effective and flexible subsequent use of the properties is often complicated. So this means we need more alliances for those areas which can become a friendly and a sustainable place. Yeah? So there's a big discussion how the German cities will survive.
I've actually had a question that sort of really is put to you. How do retail portfolios like the historic, and I will Darwi sustain and shift its focus or plan? Are retail properties like these heritage ones aided financially by government?
So the government always says, yes, we have to do a lot on our cities, on the middle of our cities, but at least you have a lot of different landlords, you have a lot of different tenants, and the engagement of the government has its borders. Yeah, I think they can do a lot on the regulation. They can do a lot to make more mix, to make it more mixed. Yeah, but I think they are not able to give money to that. Yeah, they can give better regulation for more mix and on the planning of their cities, but I think there will be no money.
Okay, thank you. Adam, we've had a question which, I mean, Suzanne may also want to take, but I mean, it says in continental Europe, we are seeing an increasing number of city hotels being offered for sale, but little demand from investors. As a consequence, a number of properties are being converted for different uses. How long do you think this situation may sustain?
I think there will be a lot. Oh, sorry, Suzanne.
Do you want to take it first?
Sure, I can have a shot. I think that there is a lot of demand from investors for hotels. I think there's a price expectancy gap, so that the demand is there. That there's been funds raised, but they're looking to invest at a slightly lower price than the sellers are willing to sell at this point. So the pure hotel buyers are perhaps not getting to the valuations that others might be. So they will be potentially bought to be repurposed as something else, maybe residential, maybe there's a few different options out there. But there is plenty of money out there on the sidelines waiting to buy hotels. And when good assets come up, they are selling at reasonable prices and not too heavily discounted from where one would have expected. I think as Josh mentioned in the UK on a few deals. Maybe that answers the question.
Okay, thank you. Suzanne, did you want to add anything to that?
Yeah, so from my point of view, this ideas to use hotels in a different way is not too bad. It's also a mix in the hotel sector. So especially for hotel properties with a focus on business tourism and maybe the cut of traveling budgets and everything. So if they don't change the use in a more mixed way, there could be a lot of price correction, and this could be significant. Yeah. So on the other hand, yeah, we will see more holiday tourism again. So interesting cities may be able to absorb some of the missing business guests, but certainly not all.
Kate, I noticed I'd seen a few reports that were suggesting similar things were happening in parts of the US.
Repurposing of,
yeah.
You know, it's interesting that you say that, because within the New York City 5 boroughs area, some of the hotels that are in and around transport areas, such as the airports, are looking to go to more long-term residential housing, as in apartments. Some of them are looking into the possibility of switching over to being affordable housing, which is something that's a very attractive play to a lender. There's affordable housing credits that permit them to move forward with that in a way that provides a better return than you ordinarily would think about. When it comes to city centers and historically designated areas, I don't know as much about that, but I will say that my family is from Philadelphia originally, and the background that I have is Scottish, English, Irish, German, and Hungarian. They all came into the port of Philadelphia, and I took a driving tour. There was a home that had been residential 100 years ago, and then morphed into a retail property, and then into a private club, was called Kung Fu Necktie, and now it's back to being residential. So I don't necessarily advise that as an arc for real estate, but it certainly is interesting, and it did that without any kind of government support.
Okay, interesting. I wanted to just, I mean, mindful of the time, but I wanted to touch on sustainability. I don't think you can go through too many of these discussions without touching on it. And I'm just thinking, Joss, you're talking about a lot of deals at the moment that you're seeing or being involved with. To what extent does sustainability play a part in this? Is it something that is, very much in the minds of the sort of people negotiating the deal, or is it not as high? Is there a lot of PR around this, but it's not seen as being, when it comes to the deal, it's not perhaps so uppermost in the mind?
I think there's a desire to act sustainably. So if I look at a hotel planning consent that I'm working on at the moment, there we're looking at using heat pumps rather than combined heat and power and things like that. I think partly it is a question of technology. That I think there's so much change going on that be it the requirement to move entirely over to electric cars by 2030, or zero emissions by 2045 or 2050. I think it's quite difficult for investors to grab hold of what they're supposed to be doing. But equally, I'm a little bit involved in looking at hydrogen and hydrogen production and use with one of the leading groups in the country, hydrogen groups in the country. And there's some fascinating things that will be happening as renewable energy becomes cheaper. We will find ourselves in a revolution that'll make this stuff easier, in my view. It may take a little bit of time, but actually I'm quite optimistic that there will be solutions out there that will become easier for the industry, and it won't be so much about simply the fabric of the building, but also about the sustainability of the energy that we put into that building that will become easier.
And is the pricing actually already reflecting, the sustainability pattern around an asset?
Certainly, large corporate buildings have to be sustainable. There's more CSR scrutiny on larger corporates. For smaller companies and so on, particularly through the pandemic, they've got bigger problems, frankly, and therefore they're not concentrating on it so much. But I think for what starts with the big ones will filter through, and we will see that change over time.
And Suzanne, what are you seeing on this one? Because I know it's an issue very close to your heart.
Yeah, so I think sustainability, ESG, however you name it, is here to stay. Yeah, and the more the awareness is rising on this point, and the society, the new generation is asking for it, so it will be also impacting the real estate sector. And as I said, yeah, the most companies say we use resources responsibly. So in this way, I think we will have to deal with that, and this will have an impact. But at the moment, a lot of money is in the market, so maybe they think twice when they buy a property, but maybe next year.
Okay, thank you. Right, a final question I want to throw out there. Big public borrowing shortfalls, or big amounts of public borrowing, huge amounts of public debt built up. Taxes at some point, I suspect, need to rise, although not necessarily everyone buys into that. Real estate seems to me quite a nice target. It's sort of fixed, easy to focus on. When one's thinking about the returns from real estate going forward, what is the risk presented by higher taxes? I don't know, Kate, any thoughts from the US, particularly given the scale of the proposed fiscal stimulus coming through?
Well, there's a lot to, as they say, unpack there. From the New York City perspective, I've been speaking to a number of people in the assessor's office, and there's an anticipation all along the way that building owners, property owners, and managers will be coming in for a tax reduction, saying that the values of their properties have dropped on a long-term basis as a result of the pandemic. That would in turn have less revenue for the cities, the counties, and the states from which to fund their own initiatives. How that flows up to the federal government is a different story as well. This is a story that's going to be part of Harvard business case studies for years to come. I can't answer anything other than observations, but that's an area of concern.
Yeah, yeah. And does anyone else want to sort of have a thought on this particular issue?
Well, property is in duck to a certain extent, I suppose, but I don't think disproportionately. I think if you see higher taxes, it will be in the form of capital gains tax, particularly, and of course at that point you're making a profit. So at the end of the day, yes, you might see some haircut from profit, but at least it's from profit rather than from ongoing taxes like rateable values, and property taxes, like Kate was saying. We have the same problem with property taxes in the UK, particularly for retail, where they are more than the rents, considerably more than rents in many cases, and that will have to be sorted out before we see any regeneration of town centres. So there's lots of conflicting issues and pushing on a string, if you want to use that phrase, that will stop them from taking too much advantage.
Okay, I'm mindful of the time, and I think we're going to have to wrap up there. We've still got some questions that have come in that haven't been answered, and we will try and get back to all the listeners in who actually did submit questions with a response. So apologies that we didn't have the time to discuss the particular issues that were raised. But I want to take the opportunity now just to thank the panel, Kate, Joss, Suzanne and Adam, for your thoughts today. I think it's been really interesting to hear the expert contribution to this debate. And I think while we get a lot of relevant insight that comes through the survey, there's nothing that beats sort of listening to people who are actually sort of operating in the market today, and I think it really helps to sort of provide some colour to the sort of numbers that we are able to gather. So big thank you to the panel. A reminder, just in wrapping up, that we will be publishing a recording and a written summary of this webinar, and that will be available online. And obviously, we would like you to feel free to share those with your professional networks. There will be an online poll at the end of the webinar. It will come onto your screen. Please take a few moments to just fill in the few questions that are there, and that will enable us to sort of get some understanding of your thoughts as to today's session. We just want to alert you to the World Built Environment Forum Global Summit. That will be taking place in Dubai as part of Expo 2020 in January 22. It's a week-long program that will focus on the livable city, stable, smart and healthy. And to register your interest and to find further details on the program, please visit the RICS website. So that's rics.org/webeth. You can, of course, follow us on Twitter, Instagram and LinkedIn. You will be able to receive news of upcoming webinars and catch up on any of those that you've missed. Finally, you can download the WebEth app from the App Store, Google Play, where you can access the latest innovative global thought leadership content across the built environment. Just want to thank you all for listening in and participating in today's event. Big thank you for that. Until next time, it's goodbye from me.